user of the information, from the communication standpoint, we've been, let's say, underwhelmed at the least at the guidance that companies have been giving as they've been approaching the standard and the effects of the standard and the adoption. So I set up an alert that I get from earnings transcripts and filings, in particular transcripts. And I would have to say on average during past earnings season throughout the year, I would maybe get 3 references to ASC 606 or IFRS 15 a day during those earnings season. This earnings season, I'm getting on average 25 to 60. So yesterday I got 60. So you can see it's finally becoming top of mind. Analysts are actually addressing this in their workflow. So we are starting to get a little bit more communication. I find the communication on the transcripts is a little bit more robust than what we're finding in the filings. That probably shouldn't surprise a lot of people here. So we're looking forward to, as the 10Ks come out, if we get hopefully a lot more quantitative information there as well. What I'll say from the both sell side and buy side response is generally accepting the guidance, accepting the information, and analysts are adjusting their models upwards, right? And usually forward. So, as a broad generalization here for most companies, we find that this is accelerating revenue recognition. I don't think that's a large surprise to most folks here. Where you're seeing that the most is within software, right? Where we had very specific revenue recognition rules around something called VSOE that goes away. Generally, software companies are recognizing revenues sooner. What they're doing with their guidance and telling analysts are incorporating in their model for the next year. That's usually what analysts pay for. And so there is what I call takers of information. You could say, well, that's not economics. But if you think about it, if you put yourself in the analyst position, there's not a lot you can do to adjust out from that, right? So I think in some sense, the buy side and sell side are forced to take this information either as today or going forward. And that's what's happening. So on a whole, we try to estimate this the best we can. I think looking at deferred revenue balances and kind of looking at which other corners of the market will have more of a sell-in versus a sell-through dynamic to it. So if you look at, again, technology equipment, I think you look at distribution within healthcare, you're going to see more accelerated revenue recognition. On a market-wide basis, we think this could be a mid-single digit revenue base shift in revenue. So ultimately, we'd be incorporated as revenue growth. And I think that's also important. Again, we can normalize for that. It's probably a lot of trading, a lot of investment is now systematic. And what I think is really interesting is I spend a lot of times with more quant shops, quant-oriented funds. There's no mechanism to adjust for this. So if you see Microsoft when they adopted quite a sizable, mid-teens base shift in revenue, if you're a computer, you're going to accept that, and you're going to process that generally as an increase in revenue growth, whether that's economics or not. So I think that's something interesting to be mindful of. A couple other notes that we've seen. It is a revenue standard, but another common theme that's been mentioned twice before me is on costs, especially sales commissions and that capitalization that's bringing. So that's a tailwind for earnings as well. And so again, we're seeing that where you have a high sales intensity. Again, software is getting the double whammy here, but also telco services. We've seen some guidance out that'll be a tailwind there as well. Seasonality, we're seeing a little bit more seasonality than I expected. I think that surprised a few people. A good example there is the insurance brokers. For their dynamic, they're now going to accelerate more of their revenue in their first quarter. So now, their guidance is it's not going to change our fiscal year, total earnings or total revenue, but we're going to have more seasonality. And so that matters. And then again, if you go back to the way computers process information, some of the factors for a defensive stock versus a growth stock is looking at the seasonality and the volatility quarter over quarter. And so what's interesting is you look at a corner of the market like insurance brokers, which is generally thought is very defensive. Now they're going to have a lot of volatility, a lot of seasonality because of this particular change in revenue. One of the other, I think, very positive pieces of feedback is billings. So a lot of software companies have been, and other companies have been, I would say, migrating their version of billings to kind of align with the version of billings that is in the new standard that Jason mentioned. I think that's a net positive, and we're going to see that across obviously all industries. That's a data point that investors have been wanting for many years now. I think that's a great step forward. And the other thing is I would focus on from a financial analysis standpoint. There's this is a revenue standard, but there's knock-on effects, right? So you think about a software company like Microsoft that effectively wrote off, I think it's close to 40-50% of their deferred revenue. What does that do to other metrics, right? So price to book looks very different. ROE now actually looks very different, right? So, and you might not use price to book as a human for valuing Microsoft. It might not make a lot of sense, but again, there's a lot of systematic strategies out there that do, and they see inflections in these factors or these metrics, and it does make investment decisions.